Right. So, before the break, we looked at an example of how to value a swap, and we looked at two approaches to do that. We talked about how the swap can be split up into or can be considered equivalent to fixed rate bond and a floating rate bond, and the two legs can be evaluated independently, and then the difference will be the value of the swap. Or we assume that the forward rates that are implied in the spectrum of spot rates prevailing at that point of time at which the swap is being valued would be actually realized in practice, and the floating rates would be fixed accordingly in terms of the forward rates that are prevailing as of today and the swap valued. Let us now, before we move on to currency swaps, let us do a problem on designing a swap. We've got two companies A and B that have been offered the following rates on a 20 million notional principal 5-year loan. Company A, if it goes to the market for a fixed rate loan, it has to pay 5% per annum, and if it goes to the market for a floating rate loan, it pays LIBOR plus 0.1%. Company B, if it approaches the market, it pays 6.4% and on the fixed rate side, and if it approaches for a floating rate loan, it pays LIBOR plus 0.6%. An intermediary is there which will get 1% per annum, which will get design a swap. So, intermediary, the swap is being negotiated through a broker or a merchant banker, and that merchant banker is going to charge 0.1% commission, and the rest of the benefit from the swap is to be distributed equally between A and B. We have to work out the modalities of the swap. So, before we work it out, let us look at the various parameters. The differential in fixed rate is 1.4%, as you can see from here, 5.0% and 6.4%. The differential is 1.4% in the fixed rate markets. The differential in the floating rate markets is only 0.5%. So, that is important, that is worth noting. Therefore, the gain that would be achieved from the swap will be equal to this minus this, that is 1.4% minus 0.5%, that is 0.9%. Out of this, the cut of the financial institution is going to be, or the swap bank as you call it, will be 0.1%. That leaves a surplus of 0.8%, which is to be distributed equally. So, both the parties A and B will get 0.4% reduction on their respective borrowings if they were to borrow as per their requirements. In other words, let us go back again. A requires floating rate funding. Therefore, if it goes to the market, it would get LIBOR plus 0.1%. You deduct a saving of 0.4%. So, A's net cost after the swap would be LIBOR minus 0.3%, whereas B requires fixed rate funding, for which it would cost 6.4% if it had gone for the fixed rate funding direct from the market, but through the swap it will get funding at 0.4% less, that is at 6%. Now, let us look at the swap. A Limited borrows at 5% fixed, and remember its requirement is floating rate. So, it borrows at 5% fixed, and against this 5% fixed, it receives 5% from the swap bank. Therefore, as far as this fixed stream is concerned, it is simply passing on what it is receiving from the swap bank onto the lenders of fixed rate, and its position as far as the fixed rate is not affected. However, it is making a payment of LIBOR minus 0.3% to the swap bank, which constitutes its actual cost, and that is a floating cost. So, A has achieved its objective of a floating rate borrowing at LIBOR minus 0.3% by this simple swap. As far as the company B is concerned, B will borrow at LIBOR plus 0.6%, and it will pay LIBOR plus 0.6% to the lenders. It receives LIBOR minus 0.3% from the swap bank, which the swap bank has received from A. So, A receives the LIBOR minus 0.3% from the swap bank, and A passes on LIBOR plus 0.6% to the lenders. So, therefore, it adds an amount of 0.9% from its own and passes on the money to the to the lenders. The important thing is that it is receiving on the floating rate and it is paying off the floating rate. Therefore, as the floating rate exposure, as far as the floating rate exposure is concerned, B is not affected. We do not consider default risk here. So, as far as B is concerned, it receives LIBOR and it passes on LIBOR to the floating rate lender. So, the floating nature of the loan is does not influence B. As far as B is concerned, it is passing on 5.1% to the swap bank. This is a fixed rate, and it is also adding on 0.9% to the stream of floating which is being added to the which is being passed on to the floating rate lenders. But the important thing is that this figure of 0.9% is also fixed, the figure of 5.1% is also fixed. So, the net cost to B turns out to be 6%, but both these streams are fixed and the floating component is simply received by it and passed on to the lenders. Its floating rate exposure is not affected. So, this is an example of the swap. These are the details in the letters. Now, what we move on to currency swaps. We have talked in detail about interest rate swaps. There can also be situations I have elucidated some of them in which the entities may prefer exchanging currencies or exchanging streams of currencies in order to suit their exposures. The typical example that we had was where a entity had borrowed in Japanese yen to finance some capital exposure, and its revenue earnings were arising in US dollars from the Middle East, and it wanted to reduce its exchange risk because it had to make installment payments against the borrowings in yen, and its receipt was in US dollars. So, it could well benefit from a currency swap. Now, a currency swap could well take the form of a fixed to fixed currency swap, where the interest rates are fixed over the tenure or the life of the swap, and only the currencies are exchanged, or a fixed once it could also take the form of a combination of interest rate swap and currency swaps, in the sense that we could have we could swap the currencies, as well as one leg could have a fixed rate of interest and the other leg could have a floating rate of interest. And there could also be situations where the principal is exchanged at the end of the swap. There could also be situation where the principal is purely notional and no exchange of the principal occurs at the end of the swap. These are variants, and these variants would be embedded, would be incorporated in the substratum of the swap contract. So, this is an example where we can look at we have got two companies, BBB and AAA, and the requirement of BBB is US dollars, the requirement of AAA is Australian dollars. The amount required by BBB is 15 million, the amount required by AA is 20 million, and the current exchange rate is 0.5 US dollars equal to 1 Australian dollar. So, you can see that in terms of the US dollar amount or the Australian dollar amount, these two are equal. The rates are, if BBB approaches the US dollar market, it has to pay 7%. If AA approaches the US dollar market, it pays 5%, and as far as Australian dollars are concerned, if BBB approaches the market, it has to pay 8%, and if AA approaches the market, it has to pay 7.6%. It is quite clear that the differential here, as far as US dollars is concerned, is 2%, and the differential as far as Australian dollar is concerned is 0.4%. Rather, the differential if BBB approaches US dollar market is 7%, and if AA approaches US dollar market is 5%, so that is 2%, and if BBB approaches Australian dollar market, the cost is 8%, and if AA approaches Australian dollar market, the cost is 7.6%. So, it is very clear and quite apparent. The appropriate thing would be that this particular AA borrows US dollars and BBB borrows Australian dollars. and then they enter into the swap, they would obviously be saving in terms of cost. For let's look at it. If BBB borrows its own US dollars, it has to pay 7%. AAA borrows Australian dollars, it has to pay 7.6%. That comes to 14.6%. And however, if BBB borrows Australian borrows Australian dollars, that's 8%, and AA borrows US dollars, that is 5%, the cost is only 13%. So, the difference in cost is 1.6%. In other words, a maximum saving of 1.6% can be achieved through the swap, right. So, if the swap bank, 1.6% out of this, if the swap bank decides to take 0.1% cut from each of them, they can still the cost that will be achieved by BBB will be 6.3%, 0.7% saving, and the cost achieved by this will be 6.9%, again 0.7% saving here. The details of the swap are given in this. If you look at this, the BBB corporation is borrowing Australian dollars at 8% and AA bank is borrowing US dollars at 5%. So, BBB is borrowed Australian dollars and it is receiving Australian dollars at 8% from the swap bank. So, in effect BBB is not the exposure of BBB to Australian dollars is nil. Whatever it is receiving from the swap bank, it is passing over to the Australian dollar lenders. So, in terms of the Australian dollars borrowings, BBB is not affected. Let us look at the US dollars. AA is borrowed US dollars and against US dollars, it is receiving US dollars from BBB. Australian dollars, it borrows at the rate of 8% Australian dollars and it receives an 8% stream from the swap bank, which it passes on to the Australian dollar lenders, right. And against this, BBB is paying US dollars 6.3% in US dollars to the swap bank, and this swap bank is passing on 5% in US dollars to the AA bank, which it is passing on to the US dollar lenders. So, US dollars 1.3% minus Australian dollars 1.1% is the cut that the swap bank is receiving. Now, we come to the valuation of the swap, how a currency swap is valued. Again, the philosophy is the same as we did for the interest rate swap. We started with, what did we do? We split up the swap into the fixed leg and the floating leg. We do the same thing here. We split up the swap into currency A and currency B, and we value the currency A leg, we value the currency B leg, and then we exchange the two and arrive at the value of the swap. That is one way of doing it. The second way of doing it, how did we do it in the case of interest rate swap? We worked out the implicit rates, implicit forward rate, and we use that same implicit forward rate on the basis that it would be the LIBOR prevailing on the reset dates. Precisely the same thing we do here. We work out the forward rates for exchange rates for the two currencies, and we assume that on every reset date, every reset date of the currency, we shall the forward rate will be the rate that is worked out at t equal to 0 on the basis of no arbitrage condition. Let us take up this example. Suppose the term structure of LIBOR to swap interest rates is flat in both Japan and the United States. The Japanese interest rate is 4% and the US interest rate is 9% per annum with continuous compounding. Some time ago, a financial institution had entered into this particular swap in which it receives 5% per annum in yen and pays 8% per annum. This is the swap content. This is the swap content. 5% per annum in yen it receives and it pays 8% per annum in dollars. This is the current structure of interest rates, 4% per annum in US and 9% per annum in US and 4% per annum in Japan. 4% per annum is the Japanese rate, 9% per annum is the US rate as of today, and the swap entailed receiving 5% per annum in yen and 8% per annum in dollars once a year. The principals of the two currencies were dollars 10 million and yen 1,200 million. The swap will last for another 3 years and the current exchange rate is 110 yen equal to $1. Let me repeat, the current interest rates are Japanese rate is 4%, US rate is 9%. The rate at which the swap was entered into is Japan 5%. The firm receives 5% per annum in yen and it pays 8% per annum in dollar once a year. That is the swap that the financial, from the financial institution's perspective. It receives 5% per annum in yen and it pays 8% per annum in dollars. The respective and the principles on which these amounts are to be calculated, on which these rates are to be applied, are $10 million and 1,200 million yen. The swap will last for 3 years. The current exchange rate is $1 is equal to 110 yen. So, let us work out the two legs. As far as this is for the dollar leg. As far as the dollar leg is concerned, what will be the cash flows? The amount of principal is 10 million and the rate is 8%. Therefore, the cash flow in dollars will be 0.8 and there will be an exchange and there will be a return of principal, that is also given. So, it will be 10 million plus this 0.8 million at the end of year 3. And what would be the discount rate? Remember, he has said that the term structure of rates is flat. That means, for all maturities the rate is the same. For maturity of 1 year, 2 years and 3 years, the rates are the same. Therefore, if the rates are the same, then what are those rates? Let us go back and have a look. It is 4% per annum in Japan and 9% per annum in the US. Therefore, for the dollar, these discount rates are at the rate of 9% per annum for all the 3 cash flows, and we work out the dollar value as this amount. Now, for the Japanese yen, the Japanese yen leg, what does it, how much is the interest flow? The rate is, the principal is 1200, the rate is 5%. So, the amount is 60 and then 1260 and the discounting is at the rate of, I think it is 5%, let me confirm, it is 4%, it is 4%, 4% and 4%. So, the discount rate is worked out at 4% and we arrive at this value for the Japanese leg. Now, to convert it to US dollars at the current exchange rate, we convert it into US dollars by dividing by 110 and we arrive at this value for the Japanese leg. So, this is the Japanese leg, this is the US leg, therefore, this is the value of the swap. This is the Japanese leg, this is the US leg and the value of the swap in terms of US dollar. It is expressed in US dollar. You can also express it in terms of Japanese yen. So, in US dollar terms, it turns out to be this amount. Now, the same thing can be done if we use the implicit forward rates, that is, if we use the forward exchange rates. Let me explain how we will work out the forward exchange rates. Now, the forward exchange rate expression we had discussed long ago. Forward rate is equal to S into exponential RH. RH is what? RH is the home currency interest rate. In this case, it will be the dollar interest rate, because we are working out from the perspective of the US dollars. So, RH is the dollar interest rate, RF is the yen interest rate, time is the maturity. So, for example, for 1 year forward rate, we have F1 dollars per yen is equal to spot rate of dollars per yen, which is given as 110 yen equal to $1 or 1 yen equal to 1 upon $110, which is being used here, exponential. This is the current rate. Please note, this is not the swap rate, this is the current rate, this is the current rate and this is the maturity of 1 year. So, this is the exchange rate, forward exchange rate at the end of 1 year. So, this is the forward exchange rate at the 1 year, end of 1 year, in terms of dollars per yen. So, this is the US dollar outflow that we worked out in the earlier case, this is the yen outflow, and this into this gives us the US dollar equivalent of yen outflow. So, the difference between this and this gives us the excess of dollar over yen, or vice versa. Negative sign means this is this minus this, the yen inflow minus the dollar outflow, that is what is here, yen inflow minus dollar outflow, and this is the discount factor. Now, because this figure is in dollars, we shall use the dollar rate. What is the dollar rate? Recall, I think the dollar rate was 9%. So, this discount rate is at 9% and we get this amount. Similarly, we work out the forward rate for 2 years, we do the same exercise again and we arrive at this. We work out the forward rate for 3 years, the forward exchange rate for 3 years. Now, please note there is a difference in cash flows because the principal is being exchanged. The principal in dollars is 10 million. So, the dollar outflow is 10.8 million, the principal in yen is 12 million. So, the dollar outflow is 1260 million. Convert this to dollars and the rest of the thing is the same and we arrive at the same figure for the value of the swap. Another example on swaps which you can have a look. Now, we come to a new topic which we have been talking about risk more or less throughout this course, and whenever we talk about risk, we talk about fluctuations, and when we talk about fluctuations, the immediate reaction is on that is by and large what we have been following, in fact, that standard deviation as a measure of risk. Now, I had right at the beginning of the course emphasized that one of the very strong reasons why standard deviation is accepted as a measure of risk is because of its simplicity, because of its mathematical compatibility and because of its cosmetic utility. So, it is not that standard deviation is unequally, unequivocally, unambiguously the best and the most optimal, most appropriate measure of risk. It has its limitations, it has its shortcomings. That is why we look at other measures of risk. One of the most prominent among those other measures of risk, which is now being used internationally across the board, is the concept of value at risk. Value at risk is also being employed in exchanges for working out margins on various positions using the software we have in India. We have the SPAN software, Standard Portfolio Analysis of Risk software, which computes margins on the basis of a certain value at risk requirement and so on. But the basic thing is value at risk is quite fundamental now in terms of risk management. Although it has not entirely displaced, in no way it has displaced the utility of standard deviation as a measure of risk, but it is gaining recognition, it is gaining importance with the growth in computing power. It is also gaining in terms of popularity. So, let us now try to understand what precisely value at risk means. See, at a very macro level, we can say that value at risk is a measure of potential loss on a portfolio. Potential loss on a portfolio due to an unlikely adverse event in an otherwise normal market condition. There is a sudden adverse event, and that sudden adverse event is detrimental to your portfolio. It is adversely affecting your portfolio, and value at risk will give you an indication, give you a feel of the potential loss that could occur or the maximum loss that could occur at given a certain probability in a certain time span. It is designated in units of money and it is a statistical measure of risk. What are the inputs that go into value at risk? Well, the fundamental inputs that go into value at risk are: number one, the portfolio, obviously, the portfolio about which you are worried, the portfolio whose value at risk is to be computed. And number two, there is a probability, it is called the confidence level. That constitutes a very important input into the value at risk. And the third is the time horizon. Over what period are you worried about the loss distribution of your portfolio? So, let us now talk about the formal definition of value at risk. The formal definition of value at risk is: I am p% certain that my portfolio loss, my portfolio W is the portfolio, loss will not exceed D over T days. Let me repeat slowly. I am p% certain, p% certain, p is a probability that my portfolio W, portfolio will be designated in rupees, therefore, the loss will change in value of the portfolio. So, it will also be designated in units of money, will not exceed D. D is a certain value of the change in value of the portfolio. So, value at risk is the change in value of the portfolio, and that change in value is D over T days. T is a time horizon. D is called the value at risk, P is called the confidence level, and T is called the time horizon. In other words, we can also say that it is the loss level, the probability of exceeding of which is 100 minus p%. Let us look at this distribution. See, this distribution represents changes in prices. Let us say I have a position, and the today's price is, let us say, S naught, and the S is the value of my portfolio, and today's price is S naught, S is the portfolio, and let us say at the end of T days the value of the portfolio is ST, let us call it DS. Now, this distribution is DS. If ST is greater than S naught, obviously we will move towards the right, and if ST is less than S naught, then we will move towards the left, and losses will occur. So, moving towards the right represents profits, represents gains, and moving towards the right represents losses. Moving towards the left represents losses, moving towards the right represents gains. In other words, DS positive represents gains, DS negative represents losses. That is, if you are talking about a gain distribution, which is what is usually considered. So, that being the case, you can of course have a loss distribution as well, it will be inverted, but the convention is to consider a gain distribution. So, DS positive moves in this direction, DS negative moves in this direction. So, what is value at risk? Value at risk is that value of loss, the maximum loss such that this probability is given to you. This probability is given to you. The maximum loss that can occur with this probability represents the value at risk. I repeat, this probability, what is the probability? The probability is this area. This area is given to you, and the maximum loss that can occur within this probability or subject to this probability represents the value at risk. One thing is also clear here, that if this probability increases, in other words, if you increase the confidence level, let us say you are talking about 95% confidence level and you arrive at this point, let us say this is 95% value at risk. Now, I say what about 99% value at risk? In other words, now this, you see, when I was talking about 95% value at risk, this area was to be 95%, this whole area is 1, and this portion of the area was to be 95%, and this was 0.05%, 5%, I am sorry. So, this area was 5%, this area was 95%. Now, when I talk about 99%, what does it mean? It means that I have to shift this value at risk to the left, and so that this area becomes 99% now, and this area becomes 1%. So, what will happen to the value at risk? The value at risk will increase. In other words, as the confidence level increases, the value at risk figure also increases, because the maximum loss that can occur with that confidence level will increase. The lower the confidence level, the lesser is the chance, the lesser is the maximum loss that can occur, higher is the confidence level, greater is the chance that greater is the loss that can occur. So, higher the confidence level, higher the probability of not occurring of a loss exceeding value at risk, and lower the probability of loss exceeding value at risk. Let us go back. If this particular value at risk confidence level is here, that means the maximum loss that can occur will be confined to this region. This is the maximum loss. This x axis or the horizontal axis represents the loss. Now, if the confidence level increases, then the maximum loss that can occur is obviously more, because you are talking about negative, you are talking about the left side, left tail. Right. Now, it is conventional when we calculate value at risk to calculate value at risk for 1 day and then extrapolate it over t days. How do we do it? We simply use the square root rule. What is the square root rule? T day value at risk is equal to 1 day value at risk into root t. So, from where do we get this rule? We will take up, but this is the basic rule that is used in general. In general, when we want to compute a t day value at risk, we first work out the 1 day value at risk and then what you call use the square root rule to work out it, to extrapolate it to a t day value at risk. We will continue from here. Thank you.